One of the largest companies in the world, and also personally one of my favorite stocks, is Microsoft Corporation, stock ticker MSFT, currently trading at $352.80 per share. This is actually the largest individual position in my dividend portfolio, making up around 8.2% of my entire dividend portfolio, and I've also seen some decent growth from this position. I'm currently up around 33.19%. Now, the company is currently yielding around 0.85%, so it does have a very low starting dividend yield, but I will show you a few reasons why you should consider this company if you are a dividend investor. Now, obviously, over the past 5 years, they've seen very good returns, up over 228% over the past year, up around 64.67%, and year to date, up almost 50%. So the past year has been really solid for this company. Now, if we dig into the dividend metrics for the company, we'll look at the dividend history, and we can see they have had 18 consecutive years of increasing those dividend payouts, and they most recently hiked their latest dividend payout to 75 cents per share a quarter. If we look where it was 10 years ago, we can see it was sitting at around 23 cents per share per quarter. So really solid dividend growth over the past decade. If we go over to the dividend growth tab here on Seeking Alpha and look at the 3, 5, and 10-year dividend growth rates, all very solid, sitting at around 10 to 11%. So that's a really solid history of dividend growth. Now, what I really love about this company is if we look to the dividend safety tab, scroll down and look at that cash flow payout ratio, you can see right here for the trailing 12 months sitting at 21.38%, and for the forward-looking year sitting at 20.02%. I absolutely love seeing companies who have a cash flow payout ratio around 20%. That leaves so much free cash flow left over to do things like reinvest back into the business, buy back shares, or pay down debt. If we jump over to the financial statements, there's a few things that I do want to point out. The first thing is if we jump over to our balance sheet, we want to be looking at 2023 or the last report. But if we come down here, we can see total cash and short-term investments now sitting at a very healthy range. And if we scroll down just a little bit further, we'll be able to see their total debts, long-term debt right here, sitting at around $41.9 billion. So their short-term cash position can easily cover their long-term debt, and that is actually very good news, especially with the recent news we've been seeing coming out around Microsoft's potential tax bill. They could potentially have a $29 billion tax bill to pay in the near future. If we scroll down, we can see in a long-awaited development, the largest audit in the history of the IRS has finally taken its next step. On Wednesday, Microsoft announced that an agency had notified the company that it owes over $28.9 billion back in taxes, plus penalties and interest. So while this specific case might be an ongoing legal battle, whether or not they have to pay that $29 billion back in taxes, the good news is, in a worst case scenario, if they do have to pay this off, their balance sheet is sitting at a very healthy level, and they have plenty of short-term cash and cash equivalents to be able to pay that down if that's necessary. Now, something else I love about this company is if we jump over to the statement of cash flows and scroll down, one of the most important metrics to me as an investor is growing free cash flow per share. And if you look at how Microsoft has done that over the past decade, it's been absolutely phenomenal growth. We can see in June of 2014, their free cash flow per share was sitting at around $3.26, and look at what it's at for the trailing 12 months, now at $8.50. If they're able to continue this trend, I feel very good about my large Microsoft position. Now, for Microsoft to be able to continue to grow at this rate over the next decade and for decades to come, I do think a few things need to happen. And one of the best ways to get insight into the company's future and its potential threats is by looking at the company's 10K. Now, reading a company's 10K actually may seem like one of the most boring things you can do, but if you do it, you'll know more than 99% of investors about that company. And I've gone through their 10K, and there's a couple of different things that I do want to point out. Now, the first thing is if we scroll down and simply look at the business prospects for Microsoft, you can see right here that Microsoft now has a large focus on AI, and they do believe that AI will play a large role in the future growth of their business, and it will be a power to revolutionize many types of work. Just a quick glance over at their website, and you can clear to see this is something they're currently trying to implement at a very large level. So when I think of AI, I really think Microsoft has a huge competitive advantage that really puts it above a lot of other businesses. Now, the 10K we were just looking at also talks about some of the strategic and competitive risks that the company is currently facing. The two biggest risks they're currently facing are competition in the technology sector. Now, I know that seems very broad, but essentially there are a lot of companies in the technology sector that are growing at a very rapid rate. And with the way that technology is constantly evolving and rapidly changing, this could potentially lead to some disruptive technologies that could pose a threat to Microsoft. The other major threat is competition among platform-based ecosystems. I still think that Microsoft has a major competitive advantage here, as they're pretty much the main ecosystem used in the business world, but there are still obviously a lot of other options that are growing in market share quite a bit. So all of these are great things to consider when looking at Microsoft as an investment, but the big question we need to answer is it trading at $352.80 a good price to consider buying in at? And to answer that question, we need to jump into my stock valuation spreadsheet, and we'll be looking at a few different valuation models to see if we can find the intrinsic value of Microsoft. And like always, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in the stock ticker Microsoft MSFT and hit enter, and you can see all of this data will automatically load in. We've already touched on these dividend metrics, and we can see the 20, 50, and 200-day moving averages all up quite a bit. Now, analysts currently have a target price of $407.87 per share, so it is predicted to grow quite a bit from its current price. Institutional ownership pretty high, and a beta of 0.88, so the volatility should be just a little bit less than that of the market. Now, the first valuation we'll look at is Graham's valuation, and this is a valuation model invented by Benjamin Graham. Basically, we plug in our earnings per share, we plug in our growth rate projection, which remains pretty high for Microsoft, multiply that by 4.4, which is the average yield on AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it is sitting at 5.33, quite a bit higher than we've typically seen it at over the past 5 years, which will drive down this valuation quite a bit. And you can see we do come to an intrinsic value of $221.70. So again, the current yield on AAA corporate bonds pushing down this valuation quite a bit. Now, the next valuation we'll look at is the discounted cash flow analysis, and basically what we're doing is we're seeing what the company is worth based on how much future free cash flow they're going to produce. So to predict the future free cash flow, we need to project a growth rate for the current free cash flow. So I look at the company's historic free cash flow growth. It's been pretty solid over the past couple of years, and if you look at analysts and sector predictions for growth, it remains very high. So I'm going with a free cash flow growth rate of 15.5 for the company, projecting that for the future free cash flows and the terminal value, which is the sum of the future free cash flows past the year 2031. I found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, which like I talked about earlier is sitting very high, subtracted out the total debt to get the equity value, divided by shares outstanding, and came to a discounted cash flow price per share of $326.72, just a little bit below that current trading price. Now, typically the next thing I look at is the multiples valuation, but I don't really like it in this scenario, so we're going to move forward and look at the dividend discount model. Now, the idea behind the dividend discount model is we should be able to value a company based on how much it pays out in dividends and how much those dividends are increasing. So while Microsoft does have a low starting dividend yield, we can see solid dividend growth rates of 9.8%, 10.71, 9.68, and the most recent 10.29%, so that's an average growth rate of over 10%, staying in line with where they've been for around the past decade. Moving forward, I'm projecting a dividend growth rate of 8.25%, discount rate of 9%, and that gives us a dividend discount model price per share of $433, quite a bit above that current trading price. So when we jump over to the output tab, we can see the three valuations that we use: Graham's at 221, DCF at 326, and dividend discount model at 433. When we average all three of these together, we come to an intrinsic value of $327.14 per share, a little bit below that current trading price. Now, if we applied a 10% margin of safety, you could see your acceptable buy price sitting at $294 a share, and with a 20% margin of safety sitting at around $261. So while the company doesn't appear to be within a buy range right now, if we look at their chart over the past couple of years, we can see there have definitely been opportunities to buy within that margin of safety. Just a year ago, the company was trading as low as around $214 per share, and for quite some time they were trading below around $270 per share. So personally, as for me, I don't plan on adding more Microsoft shares to my current portfolio. It already makes up a pretty large amount of my portfolio, but if I did see it drop back down into that acceptable buy range, maybe it is a company I would consider adding more shares of to my portfolio. But as for now, I will sit back and keep it on my watch list. But there you go, there is a quick analysis on Microsoft stock. Go ahead and let me know what you think down in the comments down below of this company. Again, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.